Hello everyone, welcome back to the channel. Today we're analyzing the latest NSE market reports released on June 1st, 2026. Instead of looking only at price action, we'll focus on what the institutional data, derivatives data, volatility reports, and risk reports are telling us about the market. By the end of this video, you'll know where smart money is likely positioning, which sectors are showing elevated risk, which stocks deserve attention this week, and what traders should watch for in the upcoming sessions. Let's begin. June started with a broad-based correction across many sectors. The derivatives volatility report shows negative returns across a large number of F&O stocks, indicating a risk-off environment rather than isolated stock-specific weakness. This is important because when weakness appears simultaneously across banking, PSU stocks, power stocks, infrastructure names, and high beta momentum stocks, it often indicates institutional portfolio adjustments rather than retail selling. The market is not yet showing panic. Instead, it is showing controlled distribution and risk reduction. One of the most important observations from today's reports is the concentration of declines in high beta stocks. Notice something interesting. Many of these stocks were among the strongest performers over the last several months. When leaders start underperforming together, institutions are usually reducing risk exposure. Now let's look at volatility. The NSEF&O volatility report highlights stocks with exceptionally high annualized volatility. Why is this important? High volatility creates both opportunity and danger. For option buyers, higher volatility means larger price swings and faster profits if the move goes in your favor. For option sellers, higher volatility means larger premium collection opportunities, but also significantly higher risk. As traders, we should understand that volatility expansion often precedes major directional moves. Looking at the futures settlement data, the market is still pricing future contracts above current spot levels in several major indices. This indicates that long-term bullish expectations have not completely disappeared. However, the immediate short-term picture has weakened. In simple words, the market is not forecasting a crash, but it is definitely forecasting caution. Institutions appear to be reducing aggressive exposure while maintaining longer-term bullish positioning. Money is rotating rather than leaving the market entirely. This is a classic institutional behavior. Professional funds rarely move completely into cash. Instead, they rotate from extended sectors into sectors showing better relative strength. Therefore, traders should focus less on stocks making new highs and more on stocks maintaining strength while the broader market weakens. These are not buy or sell recommendations. These are stocks where institutional activity and volatility characteristics suggest higher than normal movement potential. So what is the key takeaway from today's NSE reports? The data suggests broad risk reduction is underway. Institutions are becoming selective. Volatility is increasing in several high beta stocks. Market structure remains intact, but short-term caution is warranted. Traders should focus on relative strength and intelligent strike selection rather than blindly chasing momentum. Remember, price tells you what happened. Institutional data tells you why it happened, and combining both is where real trading edge comes from. If you found this analysis useful, don't forget to like, subscribe, and share this report with fellow traders. Thank you for watching, and I'll see you in the next market intelligence update.